Joining me now is Potomac Wealth Advisors founder and president, Mark Avallone. Mark, great to see you this morning. Second quarter earnings season about to kick off. Your expectations?
Well, we expect the earnings to be strong, and obviously the Wall Street does as well because stocks have been bid up. But there's good reason for it. The underlying economy remains reasonably strong. Now, we can question whether that'll slow down or not. But look, we have huge government spending as an undertow for this with the infrastructure bill and the CHIPS Act and the green energy bill. We have to remember that's trillions of dollars now being released into the economy. This AI boom, whether it's a tech company that is going to benefit directly as a direct participant in it, and now we have all these expectations that earnings are going to be boosted for companies that are using it and embedding it in their processes and getting more efficient. So if you take all that with a consumer that is perhaps slowing a bit but still resilient, and you have a strong economy, at least in the short run, and Wall Street is rewarding stock investors for that.
Yeah, it's a great point to make about all the fiscal stimulus that is still flowing, because that's been one of the issues for the Federal Reserve, right? I mean, the Fed is trying to rein in inflation, and it's faced with this tsunami of money that's still sloshing around. Take a look at interest rates this morning on the 10-year Treasury as we await commentary from the Fed today.
Well, thanks. I agree on the timing of this. Look, it's been a while since I studied economics at Rutgers, but we covered the fact that the Fed is supposed to move counter-cyclically. It's not supposed to lower rates, add liquidity, and stimulate monetary policy when asset values are soaring at all-time highs. It's not just the U.S. Japan had an all-time high. Euro's market has been remarkably strong. And we have huge government spending, fiscal stimulus. So you don't need monetary stimulus and fiscal stimulus from the U.S. government spending side at the same time. So while we have hints of slowing economy, we saw unemployment tick up to 4.1. But remember, that was also because of an increase in the labor supply. So it's not a weakening economy across the board that's going to necessitate Fed coming to the rescue. They were on the wrong side of the inflation fight for years, several years ago. So I think they are going to remain cautious, and they should. We don't want to have pain in the economy, but we don't want them to run out at the first sign of a little boo-boo and give major surgery and say, here we are. The game is, we're going to back you up. The Wall Street game is on. Lower rates are here to stay. We don't want anybody to have any economic pain ever. They can't do that again. Let a little of the free market work, and I think we'll see a slowdown, but not a crash.
Yeah, and I think that's the way viewers see it. I mean, new data from a New York Fed survey finds consumers' near-term inflation expectations have declined for the second straight month. Americans are lowering their expectation for prices of a home, prices on inflation, because it has come off of the highs. But you mentioned the federal stimulus money. That's also an issue, and that's keeping inflation elevated. I mean, you know, up 19% on Joe Biden's watch. Mark, how do you want to invest in this environment? Does this big rally in stocks continue in the second half of the year?
Well, I think a lot of 2024's second half gains have been bought early. People are front running the Fed, expecting this huge cut. We're talking about it. They haven't even whispered about it, and we're talking about it. So I think Wall Street wanted to get ahead. Tech has run up, obviously, but tech is legitimately running up because they are super strong balance sheets. They have the cash flow. And while the multiples seem high by historical standards, they're growing into them. So in an odd way, even though their valuations are lofty, there's been a sense of safety. What would be really refreshing is if the rally broadens out, and if we can get some underserved segments of this market to peek their head out a little bit and participate, but especially if we can get small and mid caps on, you can really see great returns for investors going into 2025.
Oh, yeah. We've been waiting for those small caps to join the party for sure. Mark, it's great to get your take.